Bitcoin has now seen a 12% correction in less than just 2 weeks. Now that may not sound like much, but this is the largest 14-day decline on Bitcoin since the tariff-driven correction in April of 2025. This move has led Bitcoin's price to break down from this rising wedge, which is seen as a bearish technical pattern, signaling deeper downside ahead. If this pattern plays out, it could take Bitcoin all the way down to $90,000 and possibly even lower. In order to truly understand what is happening on Bitcoin, we need to look at the U.S. Treasury bond market. U.S. Treasury bonds are what the entire financial system trades based on. Treasury bond yields vary based on what kind of growth and inflation investors are expecting, and the variations in Treasury yields will impact all assets in our financial system. They impact how mortgage rates are priced, how stocks and gold are priced, and they have a huge influence on Bitcoin. For example, back here in 2022, long-term bond yields were climbing as inflation fears dominated. This put downward pressure on Bitcoin's price, leading to a 70% decline. But once yields stabilized in 2023, Bitcoin finally found a bottom and began a sharp recovery. So Bitcoin had an inverse correlation with the 10-year yield during this period. However, if we fast forward to 2024, we can see that Bitcoin has actually had a positive correlation with bond yields. So in other words, investors have flown to safety whenever we've had signs of economic growth slowing down, which corresponds to when yields are falling, and they have been buying Bitcoin whenever economic growth has picked up, so periods when yields have been rising. Since May of 2025 though, yields have been gradually trending lower, while Bitcoin has continued to grind higher. This divergence sets the stage for three possible scenarios, each with very different implications for Bitcoin's next major move. The first scenario is that Bitcoin continues to push higher, and economic growth eventually strengthens, causing the 10-year yield to rise and catch up. The second scenario is something similar to what we saw in August of 2024. Back then, weak economic data started to show up, such as a softening labor market and rising unemployment, signaling that the economy was taking a hit from high rates. As a result, the 10-year Treasury yield fell from 4.7% to 3.6%, coinciding with a 30% drawdown on Bitcoin. The Fed responded immediately by cutting rates by 50 basis points in September, followed by 2 more 25 basis point cuts in November and December, to prevent a deeper economic slowdown. That pivot fueled a sharp Bitcoin rally into the year-end. So that's what a temporary growth scare looks like, where the Fed responds very quickly to weak economic data, and the economy does not actually head into a recession. Such a scenario today would trigger some more short-term volatility on Bitcoin as yields move lower, but eventually both Bitcoin and yields would move higher as the Fed eases monetary policy. The third scenario is an outright collapse in economic growth, which would likely trigger a sharp drop in the 10-year Treasury yield and a major sell-off in Bitcoin. For example, if we rewind to the 2020 recession, we can see that bond yields went from 1.6% to 0.5% in less than 2 months. And this coincided with a 60% crash on Bitcoin as the economy entered into a contraction. Such a development today would likely bring the stock market down significantly, which is what typically happens during economic recessions. And given that Bitcoin is extremely correlated to the US stock market, this would likely drag down its performance as well. So out of the three scenarios, the first two would be opportunities to buy the dip with a maximum 30% drawdown, and the third would suggest Bitcoin could continue to drop potentially much further. Let's see if this is something we should be concerned about. Recently, the US government posted some of its weakest job numbers since the pandemic. This is a report called the non-farm payrolls, and it shows us how much the labor market is growing each month. And we've just witnessed the US job market go from one of the hottest in history back in 2021 and 2022 to now the economy pretty much not adding jobs anymore. The reason this is important is because it brings us a lot closer to the tipping point where job growth could go negative, which effectively would mean that the economy is losing potential jobs, which is what happens heading into economic contractions. The last 3 times we saw a sustained contraction in the labor market were in 2020, 2008, and 2001 recession. In fact, 62% of Americans now expect the unemployment rate to rise over the next 12 months. This is one of the highest readings we've seen since the 2008 financial crisis. Historically, Such elevated levels have only been seen during or just before recessions. So what we're seeing today reflects a clear economic cooldown, one that could easily trigger a growth scare across risk assets. But even with signs of a slowdown in the labor market, we don't yet believe the economy is tipping into a recession just yet. A big reason for that view comes from this chart of the home builders sector. Home builders tend to lead the economic cycle because housing sits at the core of overall economic activity. Demand for new homes is highly sensitive to shifts in key macro forces like interest rates and credit availability. When conditions tighten and growth slows, housing is typically the first sector to show signs of stress. For example, heading into and during the 2008 and 2020 recessions, home builders were breaking down. If we zoom in, we can see that heading into the tariff announcement in April 2025, home builders were moving down. But since bottoming in April of 2025, the sector has rallied by more than 35%. This strength that we're seeing in this group today is keeping us constructive on the economy and Bitcoin in the midterm. But in the short term, Bitcoin's breakdown has made us cut our exposure to crypto, as there is the risk of a growth scare potentially taking price lower in the short term. However, we think that growth will eventually hold up, either straight away or later this year, and ultimately lead Bitcoin higher. This means we're still very much optimistic on Bitcoin heading into the end of the year, and we'll be continuing to look for attractive risk-reward opportunities to go long. We've been taking our clients step by step through this crypto bull run, sharing our trade setups and strategy through 3 weekly premium videos. In just the past year, our crypto trades have delivered some incredible returns, including a 30% profit on Bitcoin, 36% on Solana, and even an 83% gain on Ethereum. If you want to follow all our moves in real time, make sure to join us using the link below.